We are back talking about Centum with the CEO, Dr. James Mworia. Now, this is a very interesting company that has gone through different strategic phases. It's getting into Centum 4.0 and focusing on generating cash annuities from its existing businesses. Welcome back, Dr. Mworia. Just before we took a break, we had just finalized on you giving us an update on the real estate investment opportunities, and I think 30% IRR is very, very exciting. Now, I just want to delve into your FMCG, fast consumer moving goods segment, and what has happened there. We've seen a couple of exits, and there are ongoing exits that you actually announced during your full year presentation. Give us an update on what has been your greatest regret in this particular sector in terms of exits. Where did you make the biggest mistake?
You know, we've made a lot of decisions over the last 11 years. And really have no regret, because even the ones that have not worked well, we are a learning organization.
Okay.
I think our greatest strength is our ability to learn and be flexible.
All right.
And internalize those learnings. So when I came in, one of the first exits I had was we sold our stake in RVR.
All right.
And we sold it at a loss.
Yes.
So we are not driven by sunk costs. We are driven by the future. What can you get now? What is the best decision at this particular point in time, given the circumstances you find yourselves in, regardless of what has happened in the past? So that's sort of how we make decisions. Okay. And sort of we optimize. So many times that's what drives our exit. So you'll have an exit and realize a huge upside, because that's what makes sense at that particular point in time,
okay,
given all the information you have. And sometimes, on the rare occasions, we'll have exits where, again, we make a loss, because in our assessment, that cash flow we are getting today, all right, is higher than what else would need to invest in those particular, okay, entities, all right, just to move on. Okay. So we've had, I think, 2 occasions, which I think is a good, sort of a reasonable track record for a company where we've booked losses. But fortunately, they've also been relatively small.
All right.
So the first one in RVR was we booked a loss of about 150 million shillings.
Okay.
And now we booked a loss of 300 million shillings.
Was this King Bev?
King Bev, we booked a loss, but we looked at it and said, even if we stay on, we'd have to invest a lot more. Okay. And there was really no certainty that would have a reasonable return on it. So we have sort of decision gates and what you're prepared to put at risk, and then you review it at that particular point. Do I carry on? Do I stop? Okay. And then you try and minimize your downside risk.
Okay.
Yeah.
And what about your infrastructure projects such as Amu Power? What is happening there?
Again, there have been a lot of lessons. So we've had 2 infrastructure projects, Amu and Akira. And I think the major lesson we've learned is that these projects take a lot more time to mature than we had originally anticipated. And they are all good projects. If you look at Akira, 70 megawatts, it's green energy. We have everything. We have a PPA, we have an ERC license, we have everything. The challenge and the delay there has arisen out of the resource development process, because we have to go and drill ourselves. Okay. And we're making progress, but not as fast as we had anticipated. If you look at Amu, it's 1,000 megawatts. This is a project we thought would have, we started this project in 2014. Okay. So it's a project we had given ourselves 24 months. We thought by 2016 we would be at financial close, and it would be sort of, it had a 4-year construction period. Okay. So it's a project that should have been coming on stream with a commercial operation start date of 2020. But where we are, we've had the project has had a number of setbacks, a number of delays. But I think this is not unique to these 2 projects. If you look at Lake Turkana Wind Power Project, which is one of the major projects, it took almost 10 years. There were huge delays. Okay. So I think the lesson for us is that on infrastructure projects, large infrastructure projects, or even any medium-sized infrastructure project, yes, you have to be much more realistic in terms of how much time it will take you to overcome the various hurdles that you'll be on the road there. Yeah. Right. And so we've taken all those lessons into Centum 4.0. So in Centum 4.0, taking everything that has worked and not worked,
Yes.
we've sort of refined and said we just focus on three things. We're going to focus on our private equity business, we're going to focus on our real estate business, and we're going to focus on marketable securities. We're not going to do more development,
All right.
and we're not going to do more greenfield.
Okay, and on the private equity, I know you are raising capital to actually start a fund and allocate. How are you going? Are you going to reallocate some of the funds that you actually get from your sell-offs?
Yes,
Okay.
yes. So a lot of that are going back to the private equity business.
Okay.
Looking at new opportunities, and we have a number in the pipeline.
Are you sector specific, or are you just really looking
No,
for
we're
funding?
focusing on the same sectors we've been focusing on, because I think we have a fairly reasonable understanding of those sectors.
Okay.
And the investment universe is largely East Africa. And in terms of size, it's companies, reasonable companies with a track record, which are profitable and are looking to scale up. So providing either growth equity or in some cases buyout equity, just what we've been doing in the past.
So then now coming back to the share price, I'm wondering if you're starting a private equity fund, is it more beneficial for me as an investor to put my money alongside your money in form of seed capital, or is it better to actually buy your stock?
I think it depends on what kind of investor you are.
Yes.
Because if you are coming to join the fund, the minimum ticket size is a lot bigger.
Okay.
Maybe you're talking about $1 billion shillings to be.
Okay, yeah, maybe I'll just go to the stock market.
To be an LP investor, to be a limited partner in the fund.
Oh, wow.
But why we thought of raising a fund is because of the diversification benefit it would give us. Because if you have 10 billion shillings to deploy,
Yes.
and you deploy, say, an average ticket size of 2 to 3 billion,
Yes.
you'll only make about 3 deployments.
That's very true.
And you've run out of the money.
That's
But if you raise a fund of 300, 400, 500, that will then move maybe to 9 or 12.
9 or 12, then you
So-
can actually.
So you then have diversification for everybody.
Okay.
And the second thing is that because we're a local institutional investor, there are a lot of companies that would like Centum to be their partner, not just because Centum brings money, but because Centum is able to help them address local risks,
Okay,
local
fair
external
enough.
risks. So,
Okay, so
so we
it
have a
makes
lot
sense.
more opportunities than we have capital for.
Okay.
Yeah.
All right, now let's look at the numbers. As an investor, if you're on the stock exchange, really when your filings come out, the focus is what is my earnings per share, what is my dividend per share, what is the NAV at a group level. But then I know a lot of the activity and the value appropriation actually happens at the company. What do you think analysts normally get wrong when they're looking at your filings?
Yeah. I think if you look at it from the perspective of an investor, what I'm really interested in is what is the per share value of the company?
Exactly.
How is it growing?
Okay.
And that information you'll get in the company balance sheet.
So should I be looking at the company? Should I be looking at the consolidated?
You should be looking at the company, because the
Okay.
company gives you the performance of the business as an investment company. We are an investment company. We are not a conglomerate. And the challenge with the consolidated financial statements is that they're consolidating very unrelated businesses.
Okay.
So you have, for example, today our consolidated financial statements have consolidated a real estate business with rental income, a banking business with interest income.
So I should focus on
a beverage business with sale of sort of carbonated soft drinks.
Yes.
They're all it's very unrelated companies.
Okay.
In one agricultural companies, they're all in one
so they're
P&L.
all there.
They're all mixed in there, yeah.
Okay. But Dr. Mworia, how do I reconcile if I'm looking at your company statements? Because your profit is 743, but then there's a line of unrealized gains, which then brings the total profit to 4.7 billion.
So you know you've been doing investments. So when you report return to your investors
Yes.
on the portfolio, you report both the realized and the unrealized. So when you look at the line below the unrealized value movement,
Yes.
that is the value uplift.
Okay.
I held a share at 10 shillings, it's now 20 shillings.
Okay.
So you tell the investor I've made a return of 10.
All right.
This share also paid a dividend of 1. The 1 is the 700.
Okay.
The 10 is the one that is below there. So the total comprehensive income gives you the total return of the company relative to the book value of the assets that are available to the company. Yeah.
Fair enough. Thank you for that clarification. But then the other thing that I normally struggle with is on return on equity. Because I hear you saying your IRR for some of your projects are 28, 30%. But when I'm looking at your return on equity based on your financials, I don't know if I've calculated 10%, so I don't know if I'm actually off. So I don't know how to reconcile that.
So When you look at it, return on equity, you're looking at it on a per year basis.
Yes.
So if you want to understand what our return on equity is, then you need to look at it, because what I'm giving you a number, say over 5 years,
Yes.
over 10 years. So you need to look at what is the total equity return
Over
and then
that
get
period.
the average.
Okay.
But, because this thing tends to be volatile. So you may have some years when it's low, some years when it is high.
Okay.
The second difference is that at the asset level, you're not taking into account the money that is going to pay the debt. At the return on equity level, it is net of financing costs.
That's very true.
So those are the two adjustments that one needs to make.
Okay.
Yeah.
So then if we come back to the share price vis-a-vis the net asset value, what are we missing? Because there's almost a 50% give or take discount of what the market is actually valuing you at.
Yeah. I think what has happened, several things. One, if you look at our price, it has tended to be correlated to the index.
Okay.
So as the index has come down,
Then
so has the price.
All right.
But the price has come down at a lower rate than the index. So because the whole market has come down. If you look at the last 5 years, the entire market has come down. So our share price has been largely affected by the market movements.
Okay.
So it is. So I think the point is that there is a greater correlation between our price and the market movements than between the price and the NAV movement.
Okay.
Yeah.
So what do you think? Do you think your price should actually be trading at a premium to your book value? What do you think is a good valuation?
I think it should be trading close to NAV.
Close to NAV.
Close to NAV.
Has it ever traded
that,
there?
Yeah, and that happened from 2008 to 2015, 2016.
Okay.
The price kept track almost 1 for 1 with the NAV.
All right.
So whenever the NAV, it was sort of, the difference was not more than 10%.
Okay.
But that correlation was lost 4 years ago when the market index started, coming.
Yes, actually 4 years they've not been very good.
Yeah. So the market index started coming down, and so we lost that correlation. So as the NAV continued going up, as the market came down, so the correlation shifted from the price being correlated to NAV, it became correlated to the market.
So just pay a higher dividend, and then maybe it could.
Yeah, but as I've said, you see,
Yes.
the growth, we made a strategic decision to grow.
Okay.
To grow, we need to finance the growth.
Okay, fair enough.
And we finance the growth largely through debt. So unless you clear the debt first, you cannot enhance the dividend payout, which is what we now want to do, is to clear the debt. Obviously, had we not grown, even the issue of the price to NAV gap would never have arisen.
Okay, fine.
Yeah.
So then if we're looking at the full year 20, I don't know, what guidance are you giving investors, at least with regards to a possible dividend payout ratio, earnings growth?
We have a dividend policy, and our dividend policy is to pay the higher of the previous year's dividend or 40% of the cash income that we get, net cash income, whichever is higher. So my suspicion is that because...
And this is at a company level or at a consolidated level?
You see, we pay the dividend at a company level.
At a company. No, but the cash that you receive,
No,
are you looking at the cash?
the consolidated cash is not our cash.
Okay, so it's company cash.
Cash of all other companies.
Okay,
Yeah, that's
okay.
not our cash. Yeah?
All right.
So this is really the cash we make. So my suspicion is that because this next 1-2 years we're really focusing on debt repayment, most likely we'll keep the dividend flat.
All right.
Finish that objective first, and then now work on both either an enhanced dividend payout or a share buyback scheme.
Okay.
So sort of we're moving in a systematic manner.
Okay, makes perfect sense.
Yeah. So we have the good thing of having a clear strategy is that you remain focused on the long-term objective.
Exactly.
So we are really driven with what is the goal rather than short-term considerations, which will then jeopardize your ability to get to the long-term goal.
Then I think my final question, are there any upcoming exits outside of the ones that you already made public?
Yes, we're always working on transactions. They take time.
Okay.
So I think there's 1 or 2 major ones that we are currently working on.
All right.
And once we sign, we'll make the necessary announcements.
Okay, fantastic. Is there anything else that you really asked bring out that I might have omitted from our question and answer session?
I think this is a good time to be an investor in Centum.
Okay.
I wish I was buying my shares now. I bought a lot of my shares at 65 shillings, 50 shillings, but have no regrets.
Okay.
I see considerable value in the business, And despite all the challenges we perceive to be facing in the Kenyan economy, actually think it's a good time to be.
It's a good time.
It's still a good time, yeah.
Okay. Actually, now my very final question, because if I'm going to buy the share today and it's at about 32 shillings,
Yeah.
what are the considerations I need to look out for so that I can know if I'm buying at 32, then I can, what do I need, what triggers do I need to look out for maybe to get me to a 79 shilling level, which is similar to your NAV? And I know none of us can actually.
As a board and management,
Yes.
we have a strategy.
Okay.
That I believe if we execute and we have a track record of execution,
Okay.
we'll close the gap.
Okay, fantastic.
So your job is to enter and be patient.
Okay.
Yeah.
Enter and be patient, go long term.
Yeah.
Okay.
Enter and be patient, be long term.
Thank
If
you
you're a
so-
short-term investor, I can't assure you we'll be able to close that gap in a couple of months.
Okay.
Yeah.
And the final thing, on an individual and personal level, what are the two things that have actually made you successful over the last 11 years?
I think two things: a wonderful team.
Okay.
Very supportive mentors. I've been blessed with very supportive mentors, and a very supportive family.
Okay.
My wife, children, parents.
Wow,
I've had I've not had challenges.
You've not had challenges.
They've been extremely supportive.
So really the secret to success is be married and have good friends
And
around.
have good friends and
Okay, fine.
be stable.
Be stable.
Yeah, be
Thank you so
stable.
much,
Yeah,
Dr. James
fantastic.
Mworia. We certainly wish you all the best
Thank
with your
you.
Centum 4.0.
Yeah,
So
thank
there you have it. So this is a company that has articulated its strategy. It wants to start generating cash for itself and for its shareholders. It's trading at a discount of about 50 to 60% to its net asset value. The question is, are you actually going to join this bandwagon now, or will you wait to miss this bus as well? Thank you for joining us. See you again tomorrow at 2:30. Good afternoon.